Give us the thinking behind that, Kieran.
Well, so certainly the current trade war that we're enjoying has been instigated by the U.S., who sees a lot of imbalances that have existed for a long time, and this is a way of bringing trade partners to the table in a kind of heavy-handed way to renegotiate some of those agreements. So certainly that is the strategy of the U.S. is to adjust the existing trade framework. Everyone else is kind of caught off guard, so that's why they would lose more in the short term. But certainly, if we end up with a scenario where we've got tariffs on everything for a sustained period of time, then it's global growth that's going to suffer, and nobody benefits from that. So that's the thinking behind that story.
And Kieran, David here in Hong Kong as well. Do you think we should then move to that base case that we're talking now 200 and maybe on top of that a further 250? And equally, what will be the earnings hit in case we do get to that point?
Yeah, so I think from an equity market point of view, we're starting to are getting close to pricing in the initial 200. So and the market is already well aware of the next 250, whatever it is, 267. But I don't think we're certainly not pricing in that full amount yet. Earnings in China have been pretty good, actually, up until now. Of course, we've started to see some downward revisions in some large sectors, maybe not specifically related to what's going on with trade. So, tech, financials, we've seen some revisions, but certainly sentiment is taking a big hit from what's going on.
Well, tell me something, Kieran. How bad can it get? Because it's not just about the U.S. and China. This is the U.S. and Asia in large part as well, is it not, given supply chains and the like here in this part of the world?
Absolutely. So, that is why, we would suggest that in the long term, if we do go down this trade war path and stay in that situation, then that's bad for the region in general, not just China, for sure.